Here are the top stories we'll be watching this week. The latest US job figures will give clues on the Fed's plans for interest rates. China gears up to unveil its annual growth target. A slowing EU economy will top the agenda at the monthly meeting of the European Central Bank. And insurance company Aviva brings out results as it grapples with its future direction. First, to the US economy, which is set to show further evidence of continued strength in the labour market when data for February is released on Friday. The number of Americans filing claims for jobless benefits recently fell to its lowest level since 1969. While the Federal Reserve raised interest rates in December, as widely expected, the US Central Bank also dialed back on its pace of monetary tightening and trimmed its growth forecast for this year amid more tepid inflation readings and signs of slowing global economic growth.
The most important US economic data release coming out in the next few days is the jobs report, which is due out on Friday. Jobs growth has been remarkably robust recently in the US. January's figures showed growth of around 304,000 jobs in the month. Economists are expecting another increase for February of around 185,000 jobs. The unemployment rate, meanwhile, is at half-century lows, and the US domestic economy remains fairly robust. The Federal Reserve, which will be watching the numbers closely, is becoming more cautious, however. It's focused less on the domestic economy and more on the international economy, where it's particularly watching data in China and Europe for signs of a further slowdown.
In China, the focus is also on the economy this week, when one of the biggest events in the country's political calendar takes place. At the opening of the annual meeting of the Chinese National People's Congress in Beijing, Premier Li Keqiang will announce the government's growth target for the economy in 2019 and its 5-year development plan.
Journalists will be queuing up to be first in line to see the magic number. So why is it so important? Well, China's economy has been slowing for almost a decade. Last year, GDP growth hit 6.6%, the lowest rate since 1990, and just above the government's target of around 6.5%. Some analysts expect an even lower target this year, possibly as low as 6%. Still, that sounds pretty high to most of us, so why is it a big deal? Well, it's about expectations. China's growth boom has also come with a debt boom, as businesses take out loans expecting rapid growth. The target also gives the world a sense of how confident China's leaders really are. Growth matters for policymakers here, and they will do whatever it takes to hit their targets, including pumping cash into the economy. On Tuesday, March the 5th, we'll get an idea of just how quickly China's economy is slowing.
Moving to Europe, the eurozone economy remains in poor shape, with growth falling to its lowest level in 4 years in 2018. The European Central Bank is becoming increasingly concerned that what officials at first thought was a temporary soft patch risks turning into something more profound. The most recent figures suggest that the economy remained weak in the opening months of 2019.
It's a big week this week for policymakers at the European Central Bank. They're set to meet in Frankfurt on Thursday to begin debating what sort of aid to offer to the eurozone economy. Growth has been rather weak since the second half of last year, and the most recent data has continued to disappoint. Conditions are especially weak for the region's makers, who are under a lot of pressure from weak global demand and also from the climate of global political uncertainty. Now, what can the ECB do? The most obvious fix is to offer more cheap long-term funding to the region's banks in the form of auctions of loans known as TLTROs. The idea behind these loans is that by offering them, it will help keep borrowing costs low for the region's businesses and households, and that will boost growth.
And finally, insurance giant Aviva, which has operations in the UK, Europe and Asia, unveils its full-year results this Thursday. But the main focus will be on what, if anything, Chairman Sir Adrian Montague says about the company's search for a chief executive. The insurer parted ways with its former CEO Mark Wilson last October and promised to have a successor in place by mid-February. That deadline came and went, and the CEO's chair is still empty. Investors will be hoping for a progress update alongside the numbers.
It's approaching crunch time at Aviva. The chief executive's seat has been empty for almost 5 months, and investors are wondering what's taking so long. One reason why the board might have delayed in appointing a new chief executive is that they're not just choosing new leadership for the company, but in fact a whole new strategy for the insurer, which has operations not just in the UK and in Europe, but also around the world. Shares in Aviva have underperformed those of their big rivals for the past few years, and investors are hoping the new chief executive might be able to add a bit of fizz to that share price. There are a few schools of thought about what the new chief executive could do. One idea is that maybe Aviva could be broken up, perhaps into a UK business and an international business, or perhaps into a life insurance company and a non-life insurance company. Other investors think such radical surgery isn't really necessary, and what the company really needs to focus on in the short term is paying down debt, and then think more seriously about what to do next.
And that's what the week ahead looks like from the Financial Times in London.